The yellow states are states that are in recovery, but recovery is very, very slow. And there is some risk that if there were a slowdown in the economy, if there were to be a double dip, the chances are it would be in those states that are colored orange right now. We can bring this closer to home. This is a little odd-looking map of California. I forget about Northern California. These are the metropolitan areas of California. The northernmost metropolitan area is Redding. Sonoma County is a single county metropolitan area. And you can see that I've got Sonoma green. That my assessment is in the state of the business cycle here is now is better, and it is recovering. There are 4 factors that go into this business cycle indicator. I look at employment on a month-to-month basis and look at employment compared to where it was 6 months ago. I look at industrial production. We make estimates of industrial production based on the very, very detailed industry level data that we get from the Federal Reserve every month. I use housing starts as an estimate of local investment. It's about the only measure we have at the local level for investment. And I use house prices as a measure of household wealth. Again, it's a proxy, but it's the closest thing we have here at the county level or the metropolitan area level. Here in Sonoma, the 2 factors that really cause the business cycle index to be turning upward and for us to be putting Sonoma County in the recovery category are employment and industrial production. Those are the 2 out of the 4 factors that are turning up, and the others are essentially flat. So it's pretty good. You can see that the county fares better than the Sacramento Valley, much of the San Joaquin Valley, and even down in Southern California, LA and the Riverside, San Bernardino metro areas are seeing pretty mild pace of recovery. It's here in the North Bay and in San Francisco and Silicon Valley where we're seeing the stronger recoveries in California. I mentioned early on that the recession was particularly painful in Sonoma County. Mike mentioned the loss of 20,000 jobs from a peak back in late 2007 of about 190,000 jobs total. And you can see here, this is just the percent change year ago of employment, and I compare Sonoma County, the green line, versus California on the orange, and the U.S. on the blue. And it was remarkably a difficult period. It was very, very tough. There was really no industry left untouched in terms of the downturn. And you can see even further how far we had to go to get back to where we were. This simply takes those same employment numbers and indexes them back to December of 2007, which was the beginning of the recession. And you can see that if we compare where we are right now, we're about at that 90 bar. That means that employment is still about 10% below where it was back in its peak. That's that loss of close to 20,000 jobs. The unemployment rate is improving a little bit. It peaked at 10.5%. Now it's essentially 10% now. 9.9 was the figure for the month of May when we adjust for seasonality. What I find a little bit of heartening news here too, in fact, is that you can see the gap between Sonoma and the U.S. narrowing over the last 6 months here. There's a long way to go here, of course, but the gap is narrowing. Things are getting better and getting better a little bit faster. When we look at income growth, things are getting a little better as well. My point here is that also in terms of the county, the downturn was hardest. But when you look at late 2010, early 2011, the green bar is above the orange or the blue bar. It was the same way in terms of employment and the same way in terms of income, that the county now here is seeing a little better growth month to month, quarter to quarter than we are seeing in California, broadly speaking, or across the U.S. So the recovery is, I think, meaningful here in Sonoma County now. When we look at some of the risks that I mentioned earlier, if we look at or some of the factors that are actually helping the economy get better, one is that here in Sonoma County, households are deleveraging very quickly as well. And that will help, again, as there's real job growth returns to the county and consumers decide it's time to spend again. We look at total household debt outstanding. That's the orange line on the left-hand axis. Again, data from Equifax. We are actually back down to about a 2006 level in terms of total debt outstanding in the county. That's a really good thing. That means that the debt service burden is falling in a real way. Delinquency rates are still a little bit high. The blue bar and the orange bar here on the right-hand axis are the delinquency rates for the county, which is the blue line, and for the U.S., which is the green line. You can see that the relative rates have shifted over the last decade. For years, consumer delinquency rates were always lower in Sonoma County, given the higher per capita income here. But still, it switched, and delinquency rates are still a bit higher in the county than they are nationwide. Here again, the gap is beginning to narrow. I think I see real progress in terms of getting back on track. House prices are near bottom. They actually started to return to a little bit of price appreciation back late last year when there were federal and here in California state-level tax incentives that helped spur the housing market, gave us, I think, a little false sense of security that the bottom was here. And then when all those incentives disappeared, all of a sudden home buying slowed down again, and at the same time that there were more mortgage foreclosures, more REO properties out on the market. And so we've seen prices falter again late 2010 and into the early months of 2011. But I think as I said, I think the light is at the end of the tunnel in terms of the housing market. We get through the end of this year, I think we'll see a better 2012, some stability in 2012 in terms of house prices, and that will make a real difference in terms of consumer confidence and consumer spending. The pressure is still there, as I mentioned, in the county. This is the mortgage foreclosure inventory. This is the number of foreclosed mortgages, and I normalize it by dividing it by the number of households. So it's the number of mortgage foreclosures per 1,000 households. This is data that we obtain from RealtyTrack, which is another firm that tracks the mortgage market. And you can see here that it still is problematic in the county. The mortgage foreclosure inventory rate, if you will, is still above the U.S. average. It's above the San Jose and San Francisco metro areas. But, you know, it's kind of in the middle of the pack for the Bay Area. We look a little better than Oakland, a little bit better than Solano County, and a little better than the California average as a whole. So here again, this is simply a part of the risk for the economy. But I think that the fundamentals are getting better, and one of it is simply improving demographic trends in the county. And this, I take a longer view. This I go back to 1980, and this also helps me segue a little bit into sort of thinking about my experience here in the county over the last 15 years or so. When you look at the demographic trends here, when I began first working with the county back in 1995 and 1996, there was a real sense of optimism in the county. It's interesting, we put together a report, our first report for the county was done in 1996 when we did an analysis of the economic vitality of the county. And I was going over that report yesterday as I was on the plane coming out here, and I really did get this feeling of reading the recommendations from the Economic Development Board and our assessment of the economy, of a real sense of optimism in the county. And you can see it simply in the demographics, that year in and year out, population growth was stronger in the county than it was in the state as a whole. And I don't have the U.S., but way ahead of the U.S. And this was just one very, very positive factor. But look at, after the dot-com bust, the whole first decade of this century, and you see that there was virtually no population growth. It was just a complete change, a complete turnaround in terms of the economy. That was tough. It reflected the downturn in the housing market. It reflected very, very high home prices earlier in the decade and the inaffordability to live here. But look at the change again over the last couple of years. Once again, Sonoma County is attracting people, that net migration into the county is positive, that the number of households is growing, and that is generating long-term demand for housing, long-term demand for services like health care and professional services and education and the like. This is a really positive factor for the economy, and very, very positive in terms of creating demand for the housing market. If I move on to the next chart, this repeats the population growth rate for the county. That's the green bar. And you compare that with our estimate of housing affordability in the county. Housing affordability, the way you interpret this on the right-hand axis, it's about 90 right now. And that means that a household earning the median household income could afford to buy a home priced at about 90% of the median sales price of single-family homes right now, given certain assumptions like a 20% down payment, current mortgage interest rates, assumptions for insurance needs, and the like. And you can see that it's a near a record, and actually if I had our quarterly data for 2011 on this chart, which I don't because of the length of, I wanted to go back to 1980, this is annual data, but it's actually, affordability is actually at a record high. So again, once there's a perception that the housing market has stabled, I think we see a pretty strong turnaround in the housing market. But that change in sentiment and the ability to access credit will be very, very critical in getting that going. So our forecast is, I think I'm in agreement with you in that I'm fairly optimistic about the economy, and our forecast is fairly optimistic. This chart, the orange bar is the historical job growth rate since 2000. The green, what I've done here, this is in a sense, how do I say this? In this economic environment, being an economic forecaster has its perils. And sometimes I feel the need to defend my forecasts. And I put this on because I wanted to show that for 2010, the forecast we did a year ago was actually pretty close. I think we kind of nailed it for 2010. That we had a 2% decline in employment in 2010, and we were forecasting just a little bit over a 2% decline. So we got it right. I want you to know that. And our forecast is for a return to job growth this year. We're seeing it happen already, and stronger growth in 2010, 2011. These are percent change numbers. If we take this in terms of just job counts, we're looking at job gains in the range of maybe starting out at about 3,000 per year in 2011, maybe 3,500 net new jobs in 2012, about 4,000 net new jobs in 2013. That gets us almost back to the previous peak of employment. Not quite. It'll be mid-decade before we're back, but I think it's a little too much to ask for anything more. And you can actually see that we have trimmed our forecast back. The green forecast, the green bars represent what we were forecasting a year ago. And given what we see in the slowdown in the economy today, we're being a little more cautious in our outlook, but still quite positive. And I mentioned before, and I keep hearing this from people that I'm talking to, that the travel and tourism industry really seems to be leading the way. I've been looking at this carefully because this is an important industry for many areas around the country. And what I find really fascinating is that when using employment anyway as a measure of a turnaround in the travel and tourism industry, I use the leisure and hospitality category for employment, the gains are actually really limited and limited to the major national tourist centers in the country. If we look at, again, this is employment. I've indexed it back to January of 2008. And New York has been very strong. Orange County, Disneyland has been very strong. Orlando, Disney World, and others has been very strong as well. But as I go around and look at all the other metropolitan areas around the country, I don't see these kinds of turnarounds anywhere else. And I think, from talking to folks as I travel around the country, that there is a lot of pent-up demand for travel and tourism. Households are feeling better about being able to spend money on vacations. And the big vacations that have been put off during the recession are the ones that people are doing right now. If the promise was made to the kids 3 years ago that they were going to do Disneyland, but decided, yeah, sorry, we can't do it. Just not sure about our finances. Now the finances are looking a little better. People are taking those big vacations. And I think this is a very clear precursor of what the smaller markets all around the country will see as we get into this summer and this fall, that we are going to see a better year this year. And you actually can see, and I've put Sonoma County on this chart as well, and you can see the uptick in employment in the industry here in the county. So while it's not nearly as strong as it was in these other major national markets, things are getting better.